Let's understand what the US Fed and its decision and its commentary is likely to do for the Indian markets, not just today, but in the medium term. Joining me on the show now is Amit Kumar Gupta. Amit, good morning. And just help us make sense of the morning mood on the Indian stock markets. How much of this has to do with what happened in the US, and what are the other factors which could be driving the markets down today?
Yeah, hi Kartik, good morning. Thank you for having me. The Federal Reserve have implemented their 25 basis point rate cut. So that takes us to 100 basis point rate cut in the last 3 months in September meeting. So in a way, it ends the Fed's policy adjustments with the uh, Fed Chairman Jerome Powell indicating a more cautious approach going forward. And rightly so, the upcoming Trump administration has shifted expectations for the economy in the next year in 2025. Remember, he's going to take charge from 20th of January, and there are, a lot of adjustments will be made in the tariffs and the trade wars, etc. The Fed has noted that, some of this will factor in the potential rate cuts which they'll have in the forecast. So earlier expectation was that there are going to be three or four rate cuts in 2025. With the latest dot plot, it is down to two, but still, it's very dynamic. Depending on the environment. But for now, I think the rate cuts are sort of priced in the 100 basis point, and there will be no rate cut probably in the January meeting. And then in the March meeting, we'll see how the economy unfolds, what are the tariffs which have come into the play, and accordingly, the Fed will take its call of further rate cuts. One negative sort of point which occurred from the meeting was that Fed does not anticipate that inflation will come down to 2% in 2026. They have pushed it by 1 year to 2027. So I think that's a bit of a negative where the sort of uh, market corrected in the US, and we have followed up that this morning here in the Indian markets as well.
Right.
I think probably the negative factor would get priced in 1 or 2 days, because from now on it's more about what Trump does rather than these daily to daily movements, because eventually that will create a lot of volatility going into the next year.
All right. Amit, I want to get your view on which are the sectors in the Indian markets which are most likely to get impacted by whatever the US Fed does and whatever Trump does when he comes into office, especially with respect to tariffs that he is saying that he would impose on India. Is it fair to assume that India's IT sector is in for a fairly turbulent time going into 2025?
In general, the IT sector has withhold a little better than others, because remember, there has been a 100 basis point rate cut also, so that eases up a little bit of liquidity, and that helps IT sector in general.
Okay.
But the sectors like chemicals, sectors like textiles, even autos. I would say that these sectors will be far more impacted, because there, if the tariffs wars again start, and on top of that you have rise in inflation as well, then the supply chains again get distorted, like we saw in 2021 when the Russia Ukraine crisis broke out. And then that creates a lot more impact on these sectors rather than IT sectors, because IT, once you have got a project, once you've started implementing, then there is not much change. The only thing which changes is a little bit of slowdown in getting those projects, but implementation is not a problem. Whereas in other sectors, it becomes a problem to implement or fulfill the orders. So my sense is that a lot of these sectors can have a headwind suddenly when the tariffs war come, but ultimately, the stronger ones will push through, and the weaker ones would face much far more problems. So I'm talking about like company specific.
All right, Amit. Well, let's shift focus now as Nifty actually continues to reel under pressure. It has fallen below the 24,000 mark and stays well below those levels, about 150 points or so below the 24,000 level. Let's move on to you talking about the stronger ones and the weaker ones. Let's move on to a strong growth story, Amit, which has come by way of Zomato. Well, food delivery giant Zomato has made remarkable leaps, surpassing automobile major Tata Motors in market cap just ahead of its upcoming inclusion in the Sensex, the main index of the Bombay Stock Exchange. Remember, Sensex is a list of the 30 most valuable companies with the highest market capitalization in India. And it is going to be Zomato which will be included in that list of 30. Well, Zomato's market cap has surged 162% year to date, reaching 2.83 lakh crore rupees, overtaking Tata Motors' 2.79 lakh crore rupees market cap. Amit, what do you make of the Zomato stock? We will come to Tata Motors also, but for those who have been invested in the Zomato story, or those who've been waiting in the wings to see whether there is some momentum, or is this going to be a bubble, what is your view on the Zomato stock?
No, my view is that, firstly, as a disclosure, we don't have a positions in Zomato or Tata Motors. But my view is that eventually all the investors are playing the growth story in Zomato. So till the growth is coming, uh, especially in the quick commerce space, then the investors would continue to like Zomato stocks. But as we know, the competition is really heating up in quick commerce space. You now have Amazon page coming up. You have Ola Dash there. You also have Big Basket now. So almost every company will be planning to launch or have already launched this 10-minute kind of a delivery. And I'm not 100% convinced that going let's say 6 months, 12 months down the line, which player is going to be the winner, or which player will actually corner the market share. Obviously, Blinkit is the currently the leader and doing very well. And a lot of Zomato valuations is because of Blinkit and not so much because of the food delivery. So out of 300 rupees, I would say approximately 180, 190 rupees comes from the quick commerce Blinkit space. So
Right.
if that continues to grow and they are able to corner more market share, then I think it makes sense for Zomato to sustain these kind of valuations. But if at any point of time the growth is impacted, then I think we'll see a sharp derating also happening in the stock price.
Okay.
As far as the inclusion in Sensex etc. is concerned, I think that's a bit of a momentum play. The market caps goes up, the stock comes into the indices. The market caps goes down, the stock goes out of indices. Remember in Tata Motors case, ever since they have announced a demerger, there was always a concern that now there are two companies and both of them will not be able to be part of the Sensex or Nifty.
Right.
So they are demerging the CV and the PV part of the business. So I think the stock has also been under pressure since then.
All right. Well, I want to just spend a minute more on Zomato. The PE ratio of Zomato coming at about 347. Do you think this stock could be heading into a bubble territory, Amit?
So I think the PE is not the right metrics to evaluate Zomato or even Swiggy kind of businesses. These are eventually high growth businesses, and how much free cash flow you can generate over a period of time. That is that is going to re-rate the company. As far as bubble is concerned, where till the growth is there, the stock would do well. But it at any point of time, and we have seen that happening, that a lot of demand in the economy that is getting impacted. You have this K-shaped recovery where the rich is or the higher upper income people are able to do a lot of purchases from the economy. A lot of discretionary income is there, but that is not happening at the bottom end. So government has to give in a lot of incentives to that kind of people. So I think there is a sense that demand will get impacted. How much of that demand gets impacted in the quick commerce, that needs to be seen. But my sense is that the growth parameters on which these quick commerce companies are getting launched, that's more of a valuation game going on rather than a business game going on. So it will be difficult in the next, I would say, 6 to 12 months for companies to sustain these kind of valuations, because growth will get tapered, and the numbers would sort of shrink a little bit.
Numbers could shrink a little bit and the growth momentum may take a beating. Amit, we are talking about quick commerce, so let's shift focus now to another company, and this is India's largest automotive aftermarket platform, myTVS, which is revving up with myTVS Hypermart, a quick commerce venture for distributing automotive parts and lubricants. Deliveries to retailers and business partners will now happen in just 1 to 2 hours. So we are talking about a B2B quick commerce platform, and this is likely to set a new benchmark for speed and convenience in the auto industry. Well, shares of TVS Motor have gained about 2.25% or so in the last 1 month, and this is marginally underperforming Nifty, which has risen by about 2.9%. The stock, however, has managed to outperform other legacy two-wheeler makers like Bajaj Auto, Hero MotoCorp and Eicher Motors, all of which have eroded investor wealth by about 2 to 8% over the same time frame. On a year-to-date basis, well, the stock has delivered returns of about 23% in this calendar year 2024, significantly beating Nifty's 11% rally. Amit, your views on the TVS stock? How do you view TVS now in this context of a B2B quick commerce platform coming through?
Yeah, as a disclosure, we don't own or recommend TVS Motors. So I think this model is basically, to enable the rapid delivery of auto parts within 1 or 2 hours. We have seen that sometimes in the Indian automotive aftermarket, the parts, auto parts, spare parts which you require sometimes in a vehicle, that takes 3 to 7 days, or maybe even sometimes even more. So what they're trying to do is that through this hyper mart model, they're trying to eliminate a little bit of inventory burden and releases sort of significant working capital for the retailers. As far as consumer is concerned, I'm not sure. I mean, your car does not really break down so often. So whether you'll require this maybe once a year or maybe 1 in 2 years, I'm not sure about that. I haven't done any detailed study on that, but my sense is that it would help the retailers, because that sort of reduces significant working capitals. The dark stores on this will get sort of replenished every week from the central warehouses, so that reduces a little bit of supply chain costs. uh, and you get a sort of a quick commerce kind of experience. It provides a little bit comprehensive parts catalog and real-time order tracking as well. So it helps the retailers more than I would say, the end consumers.
All right, so it's good news for retailers, not as much for end consumers. Amit Gupta, we will leave it at that. Thank you so much for joining us today with your views.